Hey, what's up, everybody? Good morning. Welcome to today's episode of Stocks for Breakfast. It is Tuesday morning, March 3rd. I said February yesterday by mistake. And today we're going to talk about three really super important things. We're going to talk about risk, we're going to talk about opportunity, and we're going to talk about trading stocks that have the greatest opportunity for following through in the short term. A lot of what we discuss is longer term stuff, order flow, and where stocks are going between quarters from one earnings report to the next, and you can trade it between that. Today we're gonna dial it down a little bit because of what's going on in the market. There's a lot of short-term opportunity, and I want to prep everybody today for how to take advantage of volatility on a very short period, while at the same time managing your downside in case the monster rally that we had yesterday kind of doesn't have follow through. That's the best way to do it. So we're going to talk about risk, we're going to talk about opportunity, and we're going to talk about short-term follow through, which in my world, that means that we could trade cash flow. So if you enjoyed today's video, I'd really like to ask you to click down and subscribe. Today I'm wearing my fancy purple shirt, so we got some good stuff going on today, and we're going to go straight to some news. We're going to take a look at some charts, and we're going to do that all-important lesson of how to be in the right stocks during this coronavirus volatility. Okay, so let's go straight over to see what happened yesterday, and obviously monster green compared to monster red from what we had the previous day. We had a little bit of kind of a pause last Friday. Yesterday was a monster rally, and in case you don't know the exact number, it was up almost 1,300 points yesterday in the Dow. But what we're actually going to talk about today, and what we're going to focus on, is what's going on over these couple of candles in a row. And it's really called tape reading. So I'm going to get into the criteria of what to look at in some of the stocks that you might be trading, because the stocks that I might be trading might not be the right ones for you. And we're going to discuss exactly what that means today by setting up the criteria. And we're going to use some very, very simple charts. Stock futures are actually up this morning, and they're up decent. And the reason they're up decent is this story right here. There's an emergency meeting basically to discuss, should we all be cutting interest rates, and what else can we do? There's really no other way to say it. It's very good to see governments uniting to get ahead of what could potentially be a further move down, and if there's any way for them to stem it. So what I want to discuss first, though, is there's a couple of stocks in the news today. One is Target. So you should have Target in your watch list today. I'm going to pull out a little bit further. And I'm actually going to remove the moving averages, because I generally do not use moving averages to set up my charts. And that's actually something good to discuss right now as well. I really like, although moving averages are helpful, and I do use them sometimes, or I use them as a secondary indicator, I love reading the charts. And the reason I read the charts without moving averages is I want to see price action. I'll give you a really quick example here right now. In this instance here, let's say from mid-August through end of November, it's very easy to say, yes, Target is above the moving averages. We should be looking at Target. It's above the 50, right? But really the bottom line is, if I remove the 50-period moving average during the time frame, this is really what I want to know, that the stock is really in a trading range during that time period and not doing anything. And sometimes when you're looking at moving averages, you kind of get blinded by the fact that whether it's above or below the moving average, yes, it's important, but you'll also see, and we can run a scan right now, there's plenty of stocks that meet the criteria that might be bullish or bearish, but are absolutely doing nothing. They just happen to be above those key moving averages, and they're really not tradable. So I guess that's kind of a basic but advanced lesson. Basic in the sense that I'm not using moving averages. I get in there and I work the charts and literally draw the lines, but advanced in why I'm doing it. Because let's face it, you look at a movie, you could just, scans are so popular. I could do a scan, be like, oh, all these stocks meet the criteria. Yeah, but that doesn't mean they're tradable opportunities. So anyway, Target's in the watch list today because of earnings. Interestingly, Costco, I don't know if you've seen, and this, I don't mean to laugh, it's not funny, but Costco is essentially having this massive run on inventory right now for preppers because of coronavirus. I actually saw my cousin yesterday. My cousin Maria was actually taking pictures of a video. I forgot where the heck it was. I forgot what supermarket. It might have been Walmart, where all of the cleaning supplies in the store were empty. It's not funny, but it could be a tradable opportunity if this keeps up. Obviously, Costco bounced with the rest of the market yesterday, but certainly one to keep an eye on. And within the structure of what I'm about to teach you, as far as how to find the right stocks to trade for you, they have to meet your particular criteria. I'm going to show you mine, and then you could determine what criteria is good for you. And this criteria, this system that I'm about to give you, and it's a mini system. I guess you could call it a mini trading plan, but it works. And it works consistently because it's always trading with the current situation of the market. It's not trading with what happened 3 months ago or anything like that. The other stocks I want to keep an eye on, I keep going back to this one every day, and there's good reason. Netflix is not going down, and it keeps hovering at this resistance level. And the more a stock gets up to that level and stays there, the more likely that it's going to punch through. Now, I'm not saying it's definitely going to punch through. Let's face it here. We're talking about stocks for breakfast, and we're talking about trading, and we're talking about building your tracking journal from day to day where you should be setting alarms. So right now, as we've said, the stock is having a hard time getting through 388. You want your alarm to be set for 390. You don't want to get alarms where it can't keep getting up to that level and it can't punch through. Get an alarm when it gets past that level, and when it gets past that level, then you start to look if the stock punches through. Again, good trading is if this happens, then I'm doing this. If this happens, then I'm doing this. So many traders, and I'm actually going to come on the screen here. So many traders get into this thing where they'll put a trade on, and they saw it in a book, and they watched a video on YouTube, right? And they say this happened, so this should definitely happen next. That is not trading. That's chart reading. Chart reading, most chart readers struggle because they don't put together if-then scenarios. Great traders say, if this happens, then I'm doing this. And to take it even a step further, great traders know what an A-plus trade looks like. And we're actually going to get into, this is really kind of flowing into what I wanted to teach today. Great traders have an A-plus trade. If you have your A-plus trade up here, that is the perfect trade. And if that unfolds, you should have extreme confidence, both in share size, how long you plan to hold the trade, and how you're going to manage the trade, right? Once you have your A-plus trade, anything that moves away from your A-plus trade, you should have less conviction and knowing you're going to manage the trade differently. And I will tell you flat out, based on my 20 years of experience, the number one reason that smart traders who understand what they're looking at don't make money is they take too many trades outside of their A-plus trade. So once you have your A-plus trade, now you start working your way down, and you start getting all the way down to the point where you're taking trades that maybe you can't handle. Maybe trades like I showed you before in that chart in a trading range, and there's really zero edge. You'd be amazed at how many times I'm in a private coaching call or in our private Slack channel where people are messaging me about a stock, and I'm looking at it and I'm like, what are you talking about? The stock hasn't moved in 4 months. Yeah, you're guessing. Or the worst thing in the world, somebody can say, I know the stock. Well, I know the stock too. It hasn't moved. You know what's the right price? That's the right price because it hasn't moved in 4 months. That's why in my coaching program, we talk about fuel. When a stock is in a trading range and going nowhere, we want the market, we want the smart money to tell us now is the time to get involved. And a fuel candlestick is coming out of a trading range with a large green or a large red body accompanied by volume. That means the stock woke up. That means that it finally punched through that price it hasn't been able to get through. Now you should start to pay attention. So what I'm going to walk you through now, and again, I can't stress enough, if you take anything out of today's video, which the next, what I'm about to teach you is super important too, and a really good short-term trading system, you have to have your A-plus trade. As long as you know what your A-plus trade is, then you're going to say to yourself, okay, I know what my perfect trade is. How far away from this? And then you're going to start to get to the point where you say, maybe I shouldn't even trade this position. It doesn't even make sense. Why would I accept risk? Which is what we're going to talk about now. Here's the thing you want to write down. Does the potential reward potential, does the reward potential justify the risk I need to accept to put this trade on? Now, what you need to say to yourself is, how do you know reward potential? And that again gets to, how do you build an argument for a great trade, which means you have your A-plus trade and all of the factors that go into that. And I'll show you a couple in a second, from longer term to shorter term, which I think is kind of cool. We'll go longer term, shorter term. Does the potential reward justify the risk I need to accept? If the answer comes back, don't take the trade. Why one-to-one reward to risk ratios make a break-even trader? You don't want to do that. Now everybody knows there's a 3-to-1 risk reward, blah 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 blah, and that sounds great. But first of all, a lot of people pull the reward number out of their butt. A lot of people are like, yeah, I need to make 3-to-1, so I'm going to try and get out up there without any clue whether or not it's actually has a chance of getting there. So we're going to talk about that today in the short term. But here's the key: what you want to do is be confident that you have a probability of follow through, which I'm not 100% sure we got that today, because yesterday was Monday, Friday and Monday were oversold bounces. Today will dictate whether or not we actually have follow through and new buying. And I'm going to show you how to do that right now. Okay, so what we're going to discuss now is we're going to discuss risk and how to manage risk. More importantly, we're going to discuss opportunity and how to trade the right opportunity for your personal risk tolerance and how much money you have in your account. Quite honestly, a lot of people should not be trading some of these massively volatile stocks because you're going to get shaken out of them. You can't handle it because you either don't have the experience to do it, you're trading the wrong risk profile for your account size and for your experience level, and or you might just jump into them trading options when you're normally a stock trader and you have absolutely no idea whether the options you bought are expensive or cheap, which, by the way, I'm not a massive options trader, but if you are trading options in addition to reading stock charts and you're using options as a way to leverage your positions because you don't have enough money, let's say, to trade Netflix or Tesla or any one of those other stocks, get some basic stock options trading education on how to determine if an option is expensive. Because the more options and stock and the underlying stocks expand in volatility, the premiums expand in volatility. So you think that you might be trading something that has, I'm only risking $300 per contract, just for argument's sake. I'm only risking, but what you don't understand, if you don't have the right options trading education, and again, I'm not teaching options here, I'm just giving you basic stuff that I've learned over the years from people who are pretty smart that do it. You need to know whether or not that $300 you're spending actually has a chance to make money in the time frame that you need for it to make money. So it's not as simple as buying Tesla calls, believing it's going up, knowing your downside. Those options market makers are pretty smart, and they understand that there is only so much time for that option to expire, and they're going to price the options correctly so that they make money. An extreme move would have to happen in a short period of time in some of these volatile stocks. So think about that. If you are managing risk, you might want to trade some stocks that you know the downside and you're looking at the probability, which is we're actually going to discuss now. I'm not saying there's anything wrong with options. Option trading is a wonderful, wonderful business and has its place in stock trading as well, where we can use them complementary to each other. All I'm saying is get educated on what it means to buy particular options if you decide you want to trade some of these more volatile stocks. If that's not the case and you don't have that time or the experience to do that, I'm going to show you right now how to pick the right stocks for your personal risk profile, which will also be commensurate with and complementary to how much money you could make based on managing the downside. Because we're always first looking to manage the downside and get a head start on a trade. Oh, actually, that's the point. I kind of lost my train of thought there before. When people are talking about risk-reward ratio, they're talking about, I want to risk $1 to make 3, for argument's sake. Somebody might be scalping or trading on a much shorter time frame. Maybe they're making 2-to-1 and they're just making a whole bunch more trades, kind of like cash flow, and they're not really looking for that one bigger trade. Yes, we absolutely want to take trades that have perceived good reward potential. Perceived, because we absolutely have no idea which stocks are going to follow through. We have a really good system to identify which stocks should follow through. Now, here's the key that you don't read in trading books. This is the only thing that you'll learn by actually trading. All of our trades, all of our positions, if we do our job correctly, if we go in with the right mindset of I don't want to be a chart reader, I want to be a trader. Traders manage positions. Some work out, some don't. But here's the key, and you might have heard me mention this before. If you happen to be in our coaching program, you definitely heard me talk about it before. Our job is to find opportunities with a strong probability of following through, put positions on, get a head start on those positions, and then according to how we plan to manage it before we got in, we either add to the position or exit into the next pause. Our job is to find positions, I'm going to say it again, that have a high probability of following through and get a head start on a position so we can manage it. In options trading, you can build a free trade where if it moves in your favor, you sell it further out of the money, call or put. But I'm just talking about pure equity trading the way that I do it and the way I've done it and taught for a long time. Think about your positions. Your number one job is to put on a trade that has a probability of following through, where you're comfortable with the downside if it doesn't, which should be a dollar amount first. We can discuss that in a second. And look to work the beginning part of that trade. Now, what I just said about risk is a big thing. And I'm going to show you the system in just a second because it's not going to take that long. All I want you to do is to pick a dollar amount. You need to pick a dollar amount that you're comfortable putting at risk in the market. Then you look at the entry price and your stop loss and you get your shares. It's not the other way around. Too many traders just say, well, I want to risk 300 shares. I want to trade 500 shares. I want to trade 1,000 shares. Just because they believe that if they buy 500 shares and it moves X amount, they calculate in their head how much money they can make. That's the wrong way to do it. That you need to take a dollar amount, and I'll just throw a number out. If it's $300 per trade, and you have to risk $1 from your entry price to your stop loss, that's 300 shares. It's really that simple, and you calculate your share size back and forth. But here's the key. You pick the dollar amount first and then the share size. And what that allows you to do is it allows you to manage the trade comfortably because you've already accepted that dollar amount risk. So if it gets down to that level of stop loss, it's a cost of doing business. You take the loss and you go to the next trade. It's as simple as that. It's no different than inventory. Write this down. A stock trading loss is a business expense. And if you accept the business expense, no different than putting inventory on a shelf for somebody that owns a store, you're going to be able to run your business with confidence because you'll know how much inventory you can risk in proportion to how much you could make. So your trading profits are your revenue, your trading losses are your inventory. The better job you do of managing your inventory, and then the better job you do at managing winning trades, finding and managing winning trades, that's the secret formula for becoming a profitable stock trader. So what I'm going to do now is we're going to go back to the chart, back to the screen and back to the charts to look at what is a short-term trading strategy, which you can actually implement today because of the increased volatility from the coronavirus, because of the bounce, and we'll put you in a position to say, okay, this is what needs to happen today, and here's what I'm going to do. If this happens, I'll remain long. Long, if you're new to trading, means that you're a buyer. Long means you're a buyer. Short means you're a seller. If it doesn't, I'm going to reevaluate and look for another spot where I can manage my risk in exchange for the next move higher. So we're going to head to the charts, and I'll show you this lesson really quickly. So the first thing that we're going to look at is we're going to look at this area over here. And I'm constantly asked about this. So average true range is how much a stock moves from high to low in a particular day over a certain amount of time. So let's just use 14 days as the example, because that's what most softwares default to. So average true range over 1.5 means from the low to the high over 14 days. That's the average the stock moves. And I'm going to show you an example, and a couple of examples in a second. And then average volume means how many shares does that stock trade on a daily basis. And usually softwares default to 30 days. That's my base criteria before I look at anything for stocks to trade. And I'm going to walk you through exactly what that means as far as why that is the opportunity that I'm looking for. And this is what I taught my traders on my floor. Average true range means that you have opportunity to make money. Those stocks have opportunity on a regular day in and day out basis to move at least $1.50. Now that might not sound sexy to somebody who's holding stocks for months, but for a day trader, a minimum, or even a swing trader over a 1 to 3 day period, if that's what the stock does, 1.5, that means on average over 3 days or 4 days, the stock could move $4.50 to $6 on average. That's a decent short-term profit. I don't really care what you're trading. That's a decent short-term profit. When you learn to time your entries, when you learn to manage your risk, when you learn to pick the right trades, those are where the magic happens. Those setups are where the magic happens. The Average of 2 million shares per day means that institutions, the smart money, are involved in that stock on a regular, consistent basis. So we have opportunity to make money as shown by the average true range, minimum of $1.50. In my case, you might want to go down. That's why I said what matters to you. You might say, I can't handle a $1.50 swing. I might have to go a little bit lower. But this is the part here that I think that you should give strong consideration to. Anything less than 1 million does not trade enough shares on a regular basis to have consistency to the moves in the stock. And you'll see that on the stock where you see a lot of what we call melted candles, which is small bodied candles, which means there's very infrequent opportunity to make consistent money in those stocks, consistently from low to high, and close there, or high to low where you can make money. So average 2 million is what I look for an active day-to-day trade, and a minimum average true range of $1.50. Now I'm going to show you what that means in a couple of different stocks. So we're actually going to take a look at Apple, and we're going to take a look at the average true range in Apple. So the average true range in Apple is $12.20, and obviously that number is expanded over the last couple of days because of the massive crash from coronavirus and then the subsequent bounce. This is probably closer to normally 9. Maybe we'll see if it settles in after a couple of days. But what that essentially means is that also tells you profit targets. Remember before we said people just pick numbers out of their butt? That's actually what the stock does. So if you happen to be in a stock and you're looking at it for today, or you're looking at it over a bunch of days, what does the stock normally do? So if you happen to be long Apple, let me just close that out for a second and we go back to the Apple chart. If you happen to be long Apple and you're looking for profit-taking opportunities, you literally know what the stock does. So if you bought the stock at the low or near the open, and you're looking to book short-term profits, whether it's over 1 day or 2 days, so let's just use $12 as the number. 2 days is $24. So if you're long from the bottom on Friday, you just happen to be super smart and you accepted the risk and the stock bounces, it normally moves $12. Now, obviously, as we've discussed, the news completely dominates what normally happens on the charts, and these numbers are a little bit exaggerated right now. There's a lot of, obviously, yesterday we did 1,294 in the Dow. I think, if I'm not mistaken, that was the largest one-day positive move in history from a point perspective. So we're kind of off the norms here right now, and obviously Apple moved much more than that yesterday. Moved about $18, maybe almost 20, so it went past the norm. But the point is, when it starts to get up to the norm, that's when you manage your profits and you trail your profits up higher and you keep locking them in as it moves higher. So the stock itself is giving you the number to look for on a daily basis of what should be the profit potential of where it normally goes. Now I'm going to actually come back to the screen because this is actually kind of an important point. Here's where super advanced that really will help you. I just gave you this scenario for how to take a profit. Here's also where it gets really exciting. If a stock normally does $12 in a day, or just dollars, my New York just came out. If a stock normally does $12 in a day and it's already gone 9, and it's 2 o'clock in the afternoon on the East Coast, and you're looking to get long, or maybe it's gone 10 already, and the risk you might have to take is $2 in exchange for earning what it normally moves, guess what? That's a 1-to-1 trade. As exciting as that stock might be in the afternoon, as exciting as that stock might be on a weekly chart compared to what it normally might do, the odds of follow-through for a profit to justify the risk have gone down. Those are the trades you avoid. Think about that. Everybody always wants to focus on the upside and how much money they could make. When you focus on the probability of profit and if it's worth taking the trade, that's where the magic happens. That's where your account starts to grow blazing fast, because you're not throwing money away in trades that you shouldn't have been in the first place, and you're managing trades properly because you got in at the right time, you took the right dollar amount risk, and there's room to go profit potential based on everything we just talked about. So I'm going to go to the screen one more time and very briefly discuss how to trade today. Again, because everybody's got different risk parameters, but we're going to use Apple as an example, and we'll stick with this. We'll stick with the stock right now. The minimum criteria you want to see, and as we discussed before, the market is actually slightly higher this morning based on the G7 meeting. We want, as a minimum, in whatever stock we happen to be trading, and I'm just going to be looking at Apple right now, we want as a minimum it to be above today's opening price, whatever that first print is. So obviously this is the opening price in Apple yesterday, and all of this green price action was above the opening price. That was the area, if you were long, where quote unquote today's order flow matched the longer term picture, which obviously that's the longer term picture, right? So minimum above today's opening price. Again, that's the A trade, right? Minimum above today's open price, and best case scenario would be above yesterday's high. You start to work your way against that. Now, working your way away from A plus trade, still above the opening price, but above yesterday's close. If you start to have either one of those violated, where it's not above yesterday's high and above today's open, and you start to trade lower, you might still be above today's high, today's open, because you've opened here, pushed higher, but not above yesterday's close. So you see how now all of a sudden you have the best short-term indicator of whether or not you should still be long if you happen to be long the short-term pop if you're an active trader looking for quick cash flow, or if you're looking to build a position and start to pull back, you say, why would I be buying anything new here? It's continuing to pull back. So to really drill this home, we're actually going to go to the 15-minute chart of Apple from yesterday. And this here was yesterday's open price. So you can see basically on this 15-minute chart, the first hour, here's candle 1, 2, 3, 4. The first hour of the day, Apple did not get above the opening price. So there was nothing to do. You didn't even look at your screen. You didn't drive yourself crazy trying to guess until it finally got above there, and look at the reward potential for the rest of the day. So hopefully you'll watch this video a couple of times, because we really gave some in-depth lessons there on risk profiles, how many shares you're supposed to take, what it means to adjust your volatility and profit potential based on average true range, how to calculate and find the average true range for the stock that you're particularly trading. There's one thing I just want to finish up with. If you trade stocks that have an average true range that are too low, and I'm talking about whether it's day trading or 1 to 2 days, I'm not talking about holding a stock between earnings reports, because you can definitely make decent money between earnings reports if it's really good and really bad and it actually is trending. If you trade stocks with average true ranges that are too low, and let's say less than $1, just for argument's sake, you might feel safe in those trades because you can't lose too much money, but you also can't make too much money because there's no volatility that they're moving. So I use over $1.50. You can pick whatever number is good for you. You might even want to go higher than that. You know, you might be, I might be a nervous Nancy. You might be a risk taker Rob. It's all up to you. That's why I said it's personal to you. And then the upside of the average volume is that institutions will be active in that stock on a regular basis, and that's just proof, because it's in the stock every day. It does an average of X amount of shares. And the positive of that is that they are around often enough to create large red or green candles on a regular basis. And you could manage the downside, because if there's enough liquidity in those stocks, you can hit the bid or get in or out relatively quickly because of all that liquidity. And that's an upside too, is having enough shares. Some of these stocks that are very low volume, you can try and sell market out, and you could lose 50 cents just on the fill. And what you thought was a profitable trade becomes a losing trade because you didn't have enough liquidity to get out of the trade. So it's also something to consider. So I'm Pete Renzulli. Thank you for attending today's episode. I had a brain fart there because there was one stock that I wanted to go to. JD actually had a 20-day breakout. If we didn't mention that at the beginning of the video, I don't remember if I did because we had so much to cover today. JD is the stock. Welcome. Thank you for coming to Stocks for Breakfast today. Super excited that you're here with me. I really appreciate it. If you find the videos helpful, please click down and subscribe. Have an